So I just want to do a quick update video on Mullen and what I'm planning to do, where my head's at, all those good things. Um, so basically, if we look at the options, there's no change. There's no stock over $10 a strike. So $10 strike is the most, regardless which expiration date you look for. If you were there for AMC, what you saw happen was during the squeeze of AMC, the highest strike that you could find was 40, but when it squoze, like the weeks like right before expiration, the highest strikes were like 30. And basically, the day that it popped over 30, the next open on the market, the strikes were up to $145 a strike. So it closed at like $32. The strikes came in at $145 a strike, and then it ran to $72, and then it crashed from there. Now, I'm going to be looking for something similar. And so I have a lot of 350 strikes, a lot of $10 strikes. If you only have $10 strikes, what I'd recommend is when you see $7, $8, $9, $10, take at least 25% of your profits. You're going to be up 20, 30, 40x on your money. Make sure you guarantee something for yourself. But basically, I'm going to hold most of my money. And like if they dip it, so hold on, if they dip it and you took out that 20% and they dip back down to $5 with more dilution for another week or two, then that 20% that you'll have will be able to buy a way bigger position than you had before. And you could come out to like a May, this guy right here, 40 days to expire. Look at the $8 strike when it falls back down to $5 a strike, and they'll probably be around 50 cents a contract. And just with that 20% you took out, you'd be able to buy way more than what you already had in your April 22 $10 strikes. So think about that a little bit, depending on what you have. Definitely important to think about. And then basically, I'm going to look for it to close over $10 on a day. I don't know if it's going to be this week, but even if it's next week, that's fine. You should use the same type of logic. And then I'm going to look for the new strikes. And whatever, let's just say they do a $50 strike, I'm going to expect the stock price to go to $25. If they do a $100 strike, I'm going to expect the stock price to go to $50. Maybe $30 or $40. But that's kind of where my head's at. And yeah, I hope that makes sense to you. So let's look for a rip. Don't sell if you bought these guys, don't sell them too early because they're about to make so much money. When these run to $10, you're about to make so much money. And so don't sell them too early. When it starts running, if it keeps running past 5 and then 7, you know it's going to break 10. You know they want to give you those new strikes so they can get people buying the crazy, ridiculous $100 strikes or $50 strikes, whatever they decide. And then use that as a gauge of where you think they're going to cap the stock price from moving up. Because whatever the next strikes come out, like those deep out of the money strikes, they're not going to hit twice. So we're going to hit these 10s, but we're not going to hit the next round. And so don't play too stupid. And then after it breaks the 10, after it closes positive over that 10, the new strikes come, and then we have a run up. That's when I'm going to start looking for my puts, and I'm going to start adding to put positions the higher it goes. I think that's all I got for you people. Have a good day. Good luck next week. It's the week. Let's squeeze.